Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 18th of November. I'm Daniel Lam, your host for the podcast. In last Tuesday's podcast, we talked about the expectation that Trump would be diffusing geopolitical risk. Now, this is because a part of the electorate voted for him as they disagreed with the Democrats' handling of the conflict in the Middle East. This is one of the key reasons why gold has been underperforming since Trump won the elections, and it is similarly weighing upon the oil prices. Now, the US energy sector has been a relative laggard in the Trump trades. The perceived fall in geopolitical premium is one catalyst. The slowing global growth is another, which weighs upon the demand side of things. This results in limited incentive to up the production volume. Today, let us dig deeper into this. There is a recent media narrative that the second Trump administration will lead to a surge in US oil production, with producers eager to drill and produce more under perceived Biden-era bureaucracy. But US oil production, and particularly unconventional or shale oil production, has changed significantly since Trump first took office in 2017, and there are substantial barriers to rapid production increases within the time frame of a presidential term. US crude oil supply was 13.4 million barrels per day in August 2024, according to data from the Energy Information Administration. Now, this is already at a new all-time high, exceeding the previous record of 13.3 million barrels per day in December 2023. Output has risen by 4.7 million barrels per day since the pandemic-era low of May 2020, but it is already slightly above the pre-pandemic high of November 2019. US oil production growth is forecast to continue to slow this year and next. Now, US liquid supply increased by 1.6 million barrels per day in 2023, with likely growth at 630,000 barrels per day in 2024, slowing further to 300,000 barrels per day in 2025. Aside from direct impacts on US production, concerns about trade wars and associated impacts on high-demand growth centers such as China and India may dampen oil demand growth forecast, and this in turn could weigh on prices, meaning that less US oil production is economical. Thus, with the likely slowdown in production growth, demand side of things pointing towards lower prices, plus possibly lower geopolitical premium, US energy stocks do not look like the best of Trump trades at this moment in time. So therefore, we continue to favor US financials and US small caps, which are more geared towards potential deregulation and the soft landing narrative in the US economy. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.